Okay. Well, shall we go ahead and kick off? Thank you all for joining us, both people who are here at the Baker Institute and for people who are joining us online. For those of you who don't know me, I'm Mark Finley. I'm a fellow in energy and global oil with the Center for Energy Studies here at the Baker Institute. And we are here today for the latest in our series of events on the oil market. Today we're trying to preview 2020-24 as we kind of wrap up 2023. It's always been an eventful year. And we have a great panel to kind of highlight some of the key issues. So where are we right now? Oil prices today stand a bit under $75 a barrel for the international benchmark. The U.S. benchmark of WTI is a bit under $70 a barrel. That's well below where we were a year ago. The prices this year have kind of ranged between $70 and almost $100 a barrel. The average for the year is in the low 80s. That's a bit below last year's $100 average, but actually pretty much in line with the average of prices over the last 20 years or so, if we adjust for inflation, which as a card-carrying economist I have to do. Unlike the overall inflation situation in the U.S. economy, where the inflation rate has eased, but actual prices in the economy are still relatively high, oil prices actually have come down, including both crude oil and prices at the pump. And that's despite continued strong growth in global demand. The world is setting record levels for global oil demand this year, although China has been an especially difficult nut to crack, and we'll come back and talk more about that. It's really been, the weakening of prices have been a surprising story of supply. U.S. supply growth has surprised to the upside yet again, despite financial investor pressure to maintain production or financial discipline. We've also seen a recovery of production in Iran and to a lesser degree Venezuela as sanctions have either eased or enforcement of those sanctions has slackened. The result of this shifting balance has been that the so-called OPEC Plus group has had to deepen and extend their ongoing production cuts, most recently just a couple of weeks ago. So where do we stand? And where do we, what can we expect heading into 2024? We've got a great panel to discuss that. And if I may say, today's panel is a great illustration of the notion that many of you, I'm sure, know, which is that energy may be a globe-spanning industry, but it's a pretty small world. We're joined online today by Halima Croft, who's head of global commodity strategy and MENA research at RBC Capital Markets. For Halima, my factor of the small world is that she and I both had the privilege of serving our country as CIA analysts. We're also joined by Steve Lewis, the CV Star Transnational Fellow, China Fellow here at the Baker Institute. The small world here is that Steve and I share a best friend. Steve's best childhood friend growing up in the Cleveland suburbs is my best friend in the D.C. area.
Very small.
I'm sorry?
Very small.
Very small. See? And our final speaker today is Robert Mills, Director of Private Equity at Picker Energy Partners. Robert's small world with me starts today. So the way we're going to work today is that each of the speakers will have 10 minutes of introductory remarks. I'll moderate a little bit of a discussion, and then we'll go into questions, including folks here in the audience as well as people online. So Halima will go first. She'll talk about the global oil market situation and a deep dive on what OPEC has been up to. Hopefully, she'll have some comments, Halima, on the just concluded COP as well, and anything else that she thinks is important. Steve will talk about China's domestic politics and how the thinking in Beijing will impact both economic growth prospects, which, as you know, impact oil demand, but also thinking about energy security and sustainability issues and how this will impact oil demand and oil trade. And then finally, Robert will discuss the U.S. oil patch, the financial pressures that I mentioned already, productivity, acreage quality, and critically what it all means for the pathway for U.S. oil production. So with that, why don't I just turn the floor over to Halima? Why don't you go first? Thank you again.
Great. Thank you so much. And I'm sorry I'm not with you in person. I'm actually in Washington, D.C. at the moment. And I just returned from Dubai last week for COP28. And Mark, your introductory remarks were so fulsome. You stole a lot of what I was going to say in terms of where we are now in terms of the market. But what I think is interesting is sort of to take a step back and say where we were this time last year. And this time last year, we seemed to have a lot of bullish headwinds for oil. We had the lifting of the zero COVID policies in China, and your speaker is on the stage with you. We'll talk more about that, I'm sure. But there's an expectation that we were going to see significant demand growth out of China. Also, we were entering the EU six package of sanctions, whereby which the European Union had decided to essentially forego all seaborne imports of Russian oil. The US Treasury had just launched its price cap policy to essentially achieve what they said were two goals, which was to reduce Russian revenue by imposing this cap for, oil. You couldn't essentially pay more than $60 is what they said for Russian oil, but also to ensure that the seaborne oil, ban, which included a ban on the provision of services, Western services to move Russian oil to third markets, that would not take Russian oil off the market. There had been this real concern when the EU had moved forward with this six package of sanctions that services ban could lead to a multi-million barrel a day disruption of Russian oil. And the Treasury measures, again, were really designed to ensure that we would not have a significant disruption by enabling the continued provision of services to move Russian barrels to places like India and to China, since they were no longer going to Europe. But there had been concern that Europe would still see a potential winter of discontent. Nobody knew exactly how the price cap policy would work. There were concerns that there would be, disruptions just as people tried to figure out what would happen, in terms of, what were the mechanisms whereby which you could still get, European insurance coverage, to use European tankers. And so there was a sense that there could just be administrative hurdles and that you could have disruptions. There was also a real fear because the Russians had said that they were going to potentially retaliate against price caps and the EU ban, that you could see the Russians weaponizing oil exports, essentially doing to oil what they had done to gas. And so there was this sense as we headed into 2023 that we could still see some Russian supply shocks. Again, that didn't materialize, but that was one of the big, I would say, lifts to oil or expectations for higher oil prices for this year. You also had, OPEC really continuing to show that they would manage the market. We had that October OPEC meeting in 2022. That was not what the White House had wanted when they came out and announced a 2 million barrel a day production cut, while the White House was anticipating potentially problems in Europe, again, with the loss of Russian supply. And so that was seen as another sort of strength for the oil market, was the fact that Saudi Arabia, the rest of OPEC, were signaling that they were continuing to manage the market. And then you had, as you mentioned, an expectation that US production would remain restrained, that US producers would continue to exercise capital discipline. You had CEOs out there saying that we would never see 13 million barrels from the US. And so there was an expectation that between OPEC and production discipline in the US, that we would not be in an oversupplied situation while we were anticipating strong demand led by China. Now, as you mentioned, Mark, demand has actually held up this year. It hasn't been a horrendous year for demand. The IEA estimates are that demand will have grown by 2.4 million barrels a day this year. That's pretty much in line with what OPEC is forecasting as well. And yet the China numbers have been underwhelming because of the expectations that we had at the start of the year. But the big problem, I think, for the oil market, or the big sort of source of concern in the oil market, as you mentioned, has been the supply from non-OPEC countries. The US is surprised to the upside, but also we've had really strong growth from countries like Brazil, Guyana, Canada. So if you look at those four countries, that is an additional 1.9 million barrels this year out of these four key non-OPEC countries. Now, OPEC has remained, they've been playing the regulator role. They have basically said, particularly Saudi Arabia, that they will continue to regulate the market. And the Saudis over the summer went beyond the collective cut to do this additional 1 million barrel a day unilateral cut. But it's not just the non-OPEC production that OPEC has had to contend with. It's also been the production growth of countries that are exempted within OPEC. Libyan supply has held up despite some continued problems on the security side there. Venezuelan production has grown, with the U.S. pulling back sanctions on that country and giving general operating licenses to companies like Chevron that have been able to grow production in the last couple months. And there's an anticipation that we will see more out of Venezuela. Iran, though, has been the big OPEC supply story. Their exports are back to levels that we saw before 2018, when the U.S. essentially pulled out of JCPOA under Trump. And that has been, for a variety of factors, including a go soft sanctions approach by the Biden administration. And so the heavy lift of OPEC really will be set to continue as we look out to 2024. Now, there are some questions about OPEC unity. We've just had an OPEC meeting. It was a delayed OPEC meeting. It was supposed to take place in person in Vienna, but it was delayed by several days because there were issues about several African countries that were raising concerns about the production benchmarks that they had been given for 2024. As I mentioned, in June, the Saudis had announced a 1 million barrel unilateral production cut that they would add on. They called it a lollipop. But at that June meeting, they had to do a lot of work in terms of the collective OPEC numbers. UAE got a production increase for next year, but the books were squared by reducing the quotas of several African nations that were underperforming. Now, a couple of those countries, most notably Angola and Nigeria, objected to their resets, essentially saying that they would like to grow production next year. They had the capacity to do so. And so that issue was essentially punted till the end of the year, while you had secondary sources, providers assessing the production capabilities of those countries. And that was the issue that we saw in the last couple of weeks playing out at the OPEC meeting. And we still have Angola as a holdout at this moment. They have said they will not accept the numbers that they have been given. And so, yes, you have had the OPEC countries come out and say, we are continuing to manage the market. Saudi Arabia is rolled over their 1 million barrel a day unilateral cut. The collective cuts continue. Several other OPEC countries have announced additional unilateral cuts on their part as well. But a lot of market participants are looking at the growth of non-OPEC supply. They're looking at the demand picture. They're still concerned about the higher for longer rate scenario. It's very hard. It's expensive to hold oil in a higher rate environment. And they're looking at the OPEC messaging, and they have concerns about, will this group deliver on the production cuts as promised? So these are the headwinds for oil, the headwinds for OPEC. Again, I think that the Saudis backwards with barrels, but again, there are question marks over some of these other producers. The last thing I'll say before I hand this over to you, Mark, and the other panelists, is we have a situation in the market where geopolitical risk has really been largely written off by market participants, which is quite amazing considering that we're entering, we've had 2 years of this Russian invasion of Ukraine. We still have sanctions on Russia that will impact its ability to grow its production in the future. And we're 2 months into this war, the Gaza war, and there's no indications right now that we have an immediate off-ramp. Now, yes, the United States is talking about planning for when the Gaza military operation ends, but we still have real concerns about what is happening with the Houthis and continue to fire cruise missiles and drones at tankers in the Red Sea. That is a real point of concern that we are watching. And it's not clear yet that Lebanon is not going to be drawn into this conflict. And so I would say if there's a geopolitical story that we need to keep a very close eye on for next year, it is what's happening in the Middle East. So I will hand it over to you, Mark, and I look forward to hearing from the other panelists.
That's great. Thank you, Halima, very much. And it was only 2 months ago that here at the Baker Institute we had an event to commemorate the 50th anniversary of the Arab oil embargo, which the similarities with the situation today have become almost eerily similar. And I know my colleague Jim Crane, and who I think is here, and Christian Ulrichsen and I have written on different dimensions of that. Steve, Halima mentioned China, and as the China internal politics guy, please tell us what exactly is going on.
In 10 minutes, right?
In 10 minutes, yes, please.
So thank you all for inviting me. One of the reasons I'm always very excited to work with my colleagues in energy studies, I'm going now on almost 3 decades since the first paper. 1998 was the first paper I wrote about privatization and decentralization in China's oil industry. One of the reasons I'm very excited about it is that I get to really be the political scientist that I am, mainly because now I can just assume that there are economists in the room, many good economists, who actually know the Chinese market better than I do. Something I don't get to do at Asian studies conferences or political science conferences. Everybody's always asking me market questions, and say, hold those market questions, I'm going to focus on Chinese politics. And there is actually a lot going on in Chinese politics. So I would say what I'll just talk about very briefly is that there's kind of 3 things going on simultaneously that we really need to keep track of when it comes to oil markets in particular. I would say that the big one is that there's the increasing trend towards centralization under Xi Jinping and new forms of institutionalization. There are major new forms of government and party organization evolving right now that will have long-term impact, and we need to keep track of those. Kind of related to that, there's also an increasing trend towards eliminating factions and the older traditional forms of organization we saw for representing different interests within the Chinese Communist Party. But there's also, there is still a strong emphasis on a predominantly local planned economy. This is the other trend that's important here, though, is also that there is an increasing trend towards viewing national economic issues through a national security lens, which might sound like, say, well, hasn't this always been the case? Actually, no, not in energy. So about 11 years ago, one of the last major reports I wrote, I think, for the Baker Institute on the oil industry in China, we went through and actually mapped out every single leader within the Chinese Communist Party's Central Committee, the top 200, basically communists, looked at Politburo members, Politburo standing committee members, mapped out their entire institutional biography. Where did they work? What knowledge do they bring to the table? And one of the things you find is that I always like telling people, it's remarkably like the last Bush administration in some ways. I don't mean that, it's not an attack on Republicans, but what I mean by that is that kind of like the last Bush administration, you had at the very top levels of the Chinese Communist Party and the Politburo a lot of leaders who had personal experience running energy enterprises, at the very highest level. So you had these new national energy commissions, which are under the National Development Reform Commission, which is several rungs lower within the Communist Party hierarchy. But these agencies were mainly filled by people who had no experience in energy enterprises and were more on the consumption side, nothing on the production side. And so at that time we were talking about how basically the petroleum faction or energy faction is still basically running China's oil industry about 11 years ago. Just this last year, students and I have been going through and doing the same exercise, going through all of the top Central Committee members, the top 200 or so. And the one result, and this will be a new policy brief which will be coming out hopefully after in the new year, is counterintuitively, it's gone. There is no more energy faction whatsoever. It's all been obliterated in just the last 11 years. Not only that, there's been kind of a resurgence in the Central Committee of more people with a military background, but it's also every industry is basically underrepresented. There were fewer and fewer Communist Party leaders at the top levels of the Chinese Communist Party who have any experience running any enterprise in any industry. If you had to pick some, it might be people with a STEM background who actually were involved in kind of like tech enterprises. That might actually be the case. And so about a year ago, there was this major shift in the Chinese Communist Party of going through and restructuring the Central Committee, which technically chooses the Politburo and the Politburo Standing Committee and all of the people who run the government and the major central-owned enterprises in China. That is a huge change because China's national oil and gas companies have been largely running China's energy policy when it comes to oil for the last 30 or 40 years. And that is a major change. Part of it was that Xi Jinping had no choice, but in a way, but to do this, because one of his main rivals when he came in 11 years ago is a guy named Zhou Yongkang. And if you remember him, this is a guy who rose up through the ranks of both of the national oil companies. He then became head of a major province, Sichuan, and then he became the head of the Minister of State Security. Okay, so controlling these enormous resources, each of them with their own intelligence network, their own telecom network and resources, and then at the same time also running the equivalent of the CIA, for China. Very, very powerful person. Another rival was another princeling, just like Xi Jinping, the son of a major revolutionary leader, was a guy who did something very similar. He's kind of more popularly charismatic. His name a guy named Bo Xilai. But he had committed some crimes that turns out his wife had actually killed an English teacher. Okay, it happens, right? But he was eventually brought down for those reasons. But one of the things Bo Xilai was actually doing was he was bringing back more kind of mass popular movements, which is not something Xi Jinping probably really wanted to do. So he had to kind of shift to take over those as well. The other thing is that Bo Xilai was very, very close to oligarchs. Now oligarchs aren't the same in China, but think about these new tech billionaires, companies like Huawei and these other ones which have kind of been basically doing their own thing. And several of them have been brought to heel recently. You may have heard of Jack Ma, and Alibaba and everything. And Jack Ma and some of these other ones, they mainly live overseas, when they can. They've kind of been working out. They risk being, arrested if they don't exactly toe the line. And one of the reasons that Xi Jinping is very suspicious of them is because they used to lend their private jets to his competitors. So it's taken Xi Jinping a good decade to kind of get rid of those people. Both of them are in prison, by the way. Those main rivals are in prison. But in order to take down his very serious rivals, Xi Jinping had to basically go through and repick everybody, not just in the oil and gas companies, but also in the Ministry of State Security. Okay, and then start figuring out ways that you can leverage the resources of these tech companies and these tech billionaires while also keeping a very close eye on them. So if you think about that as to what Xi Jinping's tactical motivation was, throughout the last decade, it kind of explains why he's declared himself party secretary for life. Okay, that started, about 6 years ago. But since last fall, another change has happened that's also directly related Chinese politics and policy making, and that is that this last November, a year ago, he managed to get rid of all of the other kind of lower level vice premiers, that type of level of second tier cadres who were technocrats, had a lot of experience in various enterprises, but their major problem was they were picked by his predecessor and groomed by his predecessor. So starting last fall, a year ago, he's been able to stack the deck at the highest levels of the Chinese Communist Party with his own people. And this is where the uncertainty comes in, because they've not done a very good job of it, okay? And one of the problems is that he's picked people with not a lot of experience. They're picked for their kind of ideological and their personal experience at knowing Xi Jinping and having absolute loyalty to him, but they've also been making major mistakes. He hasn't been relying upon the traditional Chinese Communist Party way of having people having multiple areas of training. I usually tell people, I said, as far as I can tell, the Chinese Communist Party trains its leaders a lot like McKinsey does, in the sense that you have multiple ways of assessing, this person's strengths, both your direct line of kind of command in the hierarchy, but also people from other centers, and you kind of rotate around. You actually get to learn a lot. It's a very sophisticated way of raising leaders. Sounds like that's actually being eliminated. So the current premier of China, the number 2 person, right, in the party and the person running the government, who is supposed to be in charge of economic policy, Li Qiang, 10 years ago, he was not even a member of the Central Committee. So think about that. 10 years ago, this guy who's running China's economy day to day wasn't even one of the top 200 economists, members of the Communist Party. Okay, that would not have happened under his predecessors. Previous premiers had decades of experience working at the highest level, and they were slowly groomed and brought their way up. What you've seen this year, you've seen even more uncertainty with the defense minister, the foreign minister, right? Both disappearing. When they disappear like this, there's even rumors that the foreign minister has been killed. But it almost certainly means they're involved in some type of scandal, either a personal scandal or a corruption scandal, possibly ties to foreign intelligence. There's a lot of speculation going on. The reason is because they're grabbed and they're held in a location because under Chinese law, if you're a member of the Chinese Communist Party, you sign away your rights, to basically follow the legal procedures. So Communist Party member people I know will tell me, I actually have fewer rights than the average Chinese person. I'm not entirely sure about that. But what they mean is that if the party suspects that you've done something wrong, they'll grab you and hold you in a location where you're out of contact with your friends and family until you basically confess and give them material they need, and then a formal case is brought against you. So that's why people keep disappearing in China. It doesn't mean they've necessarily been assassinated. It means they're being held, probably in a fairly nice location, until they confess whatever it is that they've done wrong. So anyway, the last thing I just wanted to mention about this, what's also going on is that this kind of uncertainty about the people running the show in the day-to-day level, not having a lot of experience is particularly bad because Xi Jinping has made it increasingly clear that he's more concerned with national security issues than day-to-day economic affairs. So this is creating a lot of uncertainty. That's why you're seeing a lot of Chinese people talking about moving their money out of China. You've seen, especially younger people, families diversifying, sending some of their kids overseas, buying property overseas. You see Chinese companies doing the same. And so there's been an increasing emphasis on national security, and this is reflected in the Chinese leadership. There's other people who've studied it who show that many of the top levels of the party now have national security experience, more than in economic enterprises. So basically, it's a shift towards more centralized, more what Xi Jinping wants to do, but the people he's picked to run things, it's not clear that they actually know what to do. In comparison with their predecessors. There's also increasing uncertainty because everything's being made by decisions, the key decisions at the end of the day are being made by a person who's getting older, and might have issues with their health, as everybody does at some point, right? Mm-hmm. And so there's just more and more, I would say, increasing uncertainty in that type of situation. Yeah.
Thanks, Steve. And I noticed that I would note on your growing focus on national security that in recent years, China has dramatically reduced its import dependence for all forms of fossil energy, and it's increased its energy self-sufficiency ratio. So consistent with that.
Yeah, and we can talk as well a little bit later if people have questions about what this means for specific industries like the automobile industry that directly relates to oil.
Great, thank you.
Sure.
So, Robert, what's going on here in the United States?
Let me stand up here. Like so many other corporate finance, private equity investment bank types, I like to speak to slides. So when I got the opportunity to do so, I took Mark up on the opportunity. I'm Robert Mills. I'm on the private equity team at Pickering Energy Partners. Pickering is a diversified financial services business based here in Houston. We have 65 employees. We operate 4 divisions: an investment bank, a consulting business, a research practice, and a principal investing practice where I work. our private equity team is focused exclusively on the onshore North American shales, and the vast majority of the assets we own are in West Texas and New Mexico and the Permian Basin. You'll notice a number of my slides today are focused on the Permian. That's a function of, as I noted, of our investment practice, but also the Permian represents about half of onshore development, so it's a good proxy. Mark asked me to come today and give a 2024 kind of prospects for the shales, which I will do through sort of four lenses. The first of these is stakeholder and capital market sentiment. The next is operator activity surprises, then consolidation, which is an ongoing theme in our markets, and finally the kind of state of our asset base. So let's start with stakeholder and capital market sentiment. We live in a very much a show me the money market. This is very different than it was a few years ago, right? So we are no longer focused on growing materially. We are no longer focused on multiplying the underlying net asset base of our industry. We are focused on creating free cash flow, and we have been focused on that now for a few years. That is our sole purpose, and certainly I'll show some slides which explain that. My expectation for 2024 is that will not change. We have been asked by the capital markets to become free cash flow positive and to send back the money, and that is exactly what we've been doing now for a few years. To explain our relationship with the capital markets, I think it requires a small history lesson. So what I'll show here is the first 9 years of the shales, and on the left side, reinvestment rate, and on the right side, return on capital employed. So the reinvestment rate here is basically for every dollar we got out of our producing assets, how much did we put back into the drill bit? And what you'll see is that we put about 120% of every dollar we got out back in for about the first 9 years, and we did not create particularly high returns on capital. This was unpleasant for the capital markets, and for good reasons. They pulled the ripcord more or less on our business. Since that time, we've meaningfully changed the business model in the U.S. shales. The reinvestment rate is much lower. We do not put most of our dollars back into the assets, and our returns on capital, COVID notwithstanding, are much higher, and they're expected to remain higher, which has really improved our standing, I think, amongst a lot of the long-onlys in the market. You might ask the question, how did they pull the ripcord on us? And the very easy answer is they stopped giving us money, which was a good idea overall. So on the left side here, the dark blue bars are IPO and follow-on issuances to public companies, and the lighter blue bars are private equity capital raised for the energy industry writ large. As you can see, in 2017 or so, the public market kind of dropped out, and a couple years later, the private market dropped out. So there's far less equity capital being made available to the onshore shales. Also, not surprising, what did we do with less money in our pockets? We stopped spending so much money. This on the right side is an indexed and inflation-adjusted kind of basket of big shale companies and sort of what happened to their capital budgets, right? And I think the main takeaway here is on an inflation-adjusted basis, we haven't raised our capital budget since 2018, despite having an increasingly larger underlying asset base. What is the outcome of all of this is we became very cash flow positive. So free cash flow yield on the left, this industry started creating a healthy free cash flow yield. It's meaningfully above the S&P 500 at this point, and we started paying dividends. So that's on the right side. This is a dividend yield for a major E&P index. We also do things like buy back shares and pay down debt now, all things we didn't used to do. So it's become a much healthier business. I expect none of this to change in 2024. We are going to continue to be show me the money market. That's the expectation. Moving forward to operator activity surprises, I think that the narrative in operator activity surprises over the last few years has been that it's all about privates. Privates will continue to be the marginal developer and the incremental user of rigs when things change. Privates can be reactive to changes in commodity prices, changes in oilfield service pricing in a way that public companies cannot. The way I might show this graphically is on these next 2 pages. What you're looking at here is 2-year forward price expectations at any given point through the futures market, right? So spot prices are important. They're what we look at on the screen all day. But in reality, if you're looking at picking up a rig, you're talking about a multi-quarter or year-plus long capital commitment. And so what you really want to focus on is sort of what are oil prices expected to be a few years from now? What kind of market am I selling oil into? And what you can see here on this next line is public company reactions in the Permian Basin adding rigs as a function of oil price. So this chart runs from December 20 to now. This is depths of COVID, and basically publics have very slowly added rigs. These 2 lines on the screen are not particularly correlated. Public companies are not particularly reactive to what's going on in the field. They're just really being governed by that show me the money attitude and a very slow and steady return of their rig program from pre-COVID. Next, I'll show you private companies. Clearly, these 2 lines are much more correlated. Private companies are reactive to what's going on at well level economics. Private companies increased their rig count coming out of COVID by 350% in the Permian Basin. They have since given back about half of those rig adds. So really the way to think about privates is they are the marginal user. The important things to note on privates are they have less attractive acreage overall, they have less years of drilling inventory, they have way less implications for changing their budget mid-reporting cycle, right? They do not have to do a quarterly call with investors in a couple of weeks. And then they have less long-term oilfield service contracts. So this all allows them to be reactive. They are the marginal user. If there are surprises in 2024 on the operating side, it's going to come from large private companies. Back to our next point, which will be consolidation. This is a huge theme going on in the E&P market and onshore. Our industry has too many companies, and we need to have a lot less of them. So we've been working on that. The narrative has been more please, and it will continue to be more please. Is certainly my expectation. We saw a lot of M&A this year. We saw some enormous deals in the form of Exxon Pioneer, Chevron Hess. There are still a number of important remaining chess pieces in the onshore oil market. Those were two of the biggest, but there's still many cards left to flip. We will see some more of them, as a number of you know, on Monday. Another enormous one flipped, which is Crown Rock was bought by Occidental. So this is not a story that's going to change. We need to have less companies. We need to rationalize assets. That will be a big part of the 24 and beyond story. The left side of this page is a total eye chart, and I apologize for that. But this is 31 deals that were done by big public companies in the shales this year. And I don't want you to learn anything except these two columns on the right that I've highlighted. This is me and my team deciding which of these deals was about inventory and which was about scale. And there's 31 deals here. We did it over the weekend, so it's not updated for Crown Rock. But of the 31 deals, we would tell you that 24 were about buying more inventory, and 18 were about increasing scale. This is what public companies need now in the shales. They don't get a lot of attention from public shareholders, and in order to get attention, they need to be bigger. They need to have more shares that trade each day. People need to care more. So there's a huge bid just to be a big buyer, become a big company. This chart on the right, I think, makes that very clear. This is public companies as a percent of the buyers. They are increasingly becoming the consolidators of our industry. Again, we have less companies. We have less incremental assets being added to the stack, and they're all going to end up in a few survivorship hands. The big public companies are going to be the survivors. This next page touches a little more on the nuts and bolts of the M&A business. The blue bars are transaction count, right? So we're doing less deals almost at all times. However, we are doing way bigger deals. Red line is median transaction size. The reason for that is that public companies do not want to buy $50 million assets. They want to buy $500 million assets. And so there is a huge ask from us, the private equity community and the small independent community, to create big things for them to buy. And they're willing to pay a premium for it, and they've proven that now a lot of times. Again, Monday notwithstanding, that was an enormous price for Crown Rock. Finally, I'll touch on the state of the asset base. We hear a lot of people asking about productivity and inventory. There's certainly a narrative that productivity is going down and that inventory is running out. My expectation for 24 is that productivity, that story will probably start going away. We don't see it as much in the data. People love to talk about it, but I don't think it's as real. The inventory story is super real and is probably going to get worse. The shales are finite, and I think that's going to become more real for a lot of folks. I'll touch on the productivity point first. On the left side, this is 12-month cumulative barrels of oil per foot out of horizontal wells in the Permian Basin. What you can see is that from 2012 to 2016, we had incredible efficiency gains and enormous growth in the productivity per foot. And that since then, it's kind of gone nowhere. I've seen versions of this chart put out by certain research shops, which actually suggest it's starting to go down. It kind of depends on how you cut the data. But what I think this chart misses is that the lateral length of the horizontal wells drilling is constantly increasing. If you can get the same amount of oil over the first 12 months on a per foot basis out of a longer lateral, you've actually drilled a slightly better well. There's good physics and downhole property reasons for that. So we would tell you that wells are getting slightly better. They're not getting materially better, but we don't think they're getting worse. So I think that the story of productivity is going down is probably a false narrative. However, I think importantly on the right side, something to know about the shales is that the predictability of the shales is getting better. So this is the relationship between the P70 and the P30 outcome of drilling a well in the Permian Basin. It is a tightening band. This is the sign of a maturing industry. This is a more predictable resource. We all just on the margin know what we're doing in a way that we didn't know a decade ago. And I think certainly this is reflective of how we're being thought about by the public markets now. Everyone knows a little more what they're going to get out of the hole every time they drill another well. Let me touch on inventory very quickly. The best way to think about inventory, I think, is through some maps. So this is the Midland Basin. It's the eastern half of the Permian. This is in 2013. All the little green, blue sticks you see are horizontal wells that existed at that time. as you can see, there was some stuff going on in the southeast part of the basin, but overall the basin is fairly empty. It's a pretty blank map. Fast forward to 2017, and we're starting to fill it in, right? There's a lot less inventory. There's a lot less blank space. Certainly we are starting to create the edges of the basin. People are finding kind of where it ends. Now here's today, right? We're certainly, this has become a filling in the gaps story. There is a lot less inventory in the Midland Basin than there was. We are creating new resource on the margin, but for the most part, we're filling in gaps. And I mean, a big part of why Crown Rock traded for the price that it did is they had some of the best gaps left in this basin. So, shale is finite. Are there 2 years of inventory? No. Are there 20? No. So I think that's an important thing for America and for the capital markets to grapple with. Is we've enjoyed wonderful energy resource and a lot of independence as a function of the onshore North American shales, but they will eventually run out. So bottom line, I think that 24 is a heads down year for our industry. We're not going to change. We're not going to start growing again. We're a very mature industry on the margin. We're about cash flow. Private companies will continue to be interesting. They will attract attention from an operator perspective and from an operating surprise perspective. M&A continues to be an important thing and will be even bigger next year. And finally, the story of inventory is sort of the next few years of all of our lives. I think that there will be a bigger and ongoing drumbeat regarding, what are we going to do about the finiteness of the shales. So anyway, thank you all, Mark.
Great, thank you, Robert. I appreciate that, and so we're going to move into a discussion here. I'll start with asking each of the panelists a question and give you all a chance to start thinking about your questions as well. By the way, for people who are joining us online, we have the ability to screen questions there as well. They'll get pushed to my screen here, so we'll take both questions from folks who are joining us in the room as well as people who are joining us online. But I get to go first. So Halima, you first. One thing I think I've noticed over the last couple of years is an increasing almost hostility between groups that represent the producers, i.e. OPEC and now OPEC Plus, and groups that represent consumers, and in particular the IEA. There's been just a war of words over both, well, our forecast is better than yours. No, your forecast is politicized. And on bigger topics like, hey, does the oil and gas industry have to, plan for a post-oil demand future, or is the world going to continue to need oil going forward? And I'd be interested in your thoughts about not just what's happening, but what are there real ramifications in terms of, how producers and consumers engage with each other and what it might mean for the markets going forward?
Yeah, that's a fantastic question, and we've certainly had some colorful language between OPEC countries and the IEA. Prince Abdulaziz referred to a now famous IEA report, basically as La La Land, where the IEA in one basic scenario basically said about if we're going to reach our targets for net zero and 1.5, we really need to almost have no investment in oil and gas, and that really caused quite a firestorm, that report. But I think it goes beyond the questions, with the IEA basically saying you could have a stranded asset. Don't make big investments, to, very much talking about an accelerated energy transition. And you have, key OPEC countries saying, no, we think demand for energy is going to remain robust, even in a transition scenario. OPEC, leaders often highlight, more the energy access issue, the fact that you have millions of people without access to stable, reliable, affordable energy, using biomass to heat their homes. And so this is the heart of the matter, is the debate about what is the energy transition going to look like? What's the pace of the energy transition? What type of investment do you need in oil and gas to ensure that we don't have whole parts of the world sort of left behind? And we saw this really playing out at COP as well, the debate over whether we should have phase out in the language, phase down in the final communique, or where we landed, which was essentially a more sort of nuanced statement about transitioning away from fossils in a way that still ensured a just, equitable energy transition. So that, I think, is the heart of the matter. But there's also another issue that I think bears mentioning, is that when we had the Russian invasion of Ukraine, the IEA was out really talking about a potential, multi-million barrel a day supply disruption coming out of Russia. And I think that there's some in OPEC that believe that the IEA's, really strong warnings about this incentivize the United States to start releasing barrels from the Strategic Petroleum Reserve, which, they saw as this, pretty aggressive intervention in the market. And so I do think that has also been a bit of a lingering issue as well, the type of forecast that the IEA was making and the policy response that engendered from the Biden administration in the first year of the Russia-Ukraine war.
Thank you. Steve, your turn. You teed me up with a big softball saying, hey, somebody asked me about what this means for the Chinese auto industry. So go ahead. EVs,
Sure.
internal combustion engines, domestic export, what's driving?
So I think what I mentioned before, which is that Xi Jinping has been kind of choking up on the bat on control over central-owned enterprises and local enterprises is definitely true. Historically, in China, most manufacturing and resources are run by local governments. And the central government historically has said, hey, when these enterprises are doing really well, they're making a lot for the national economy, it's something we can tax, or if it has a national security interest, let's nationalize it. Let's bring it up to national level of ownership. And then once it begins to lose money, like textiles, let's push it back down and let the local governments deal with the consequences, the laid off workers and things. That's historically the way China works. Most recently, things like high tech, where the Chinese central government makes huge investments, in research. So anything related to like AI, tech, a lot of the new stuff on microchips and things like that, where the central government is the main investor from the get-go, they're definitely going to be, very, very important. If it's things like, oil and gas, historically, there's been tension. Mainly between the upstream has been largely controlled by Beijing, the downstream and refining largely by local governments. And a lot of tension between those two. The one industry that is historically, uniquely, unlike a lot of other countries, quite different has been automobiles. The central government in China, unlike Russia or a lot of other countries, has never had a dog in that fight. Okay, there's never been like a major central-owned Chinese car factories. There's always been any number of provinces with their own car companies, which meant that there's been a lot of foreign partners. So every major international, multinational car company has had a different a different partner within different parts of China. And so that's not surprising, for example, when we've criticized the Chinese government in the past for saying, hey, you agreed to all these things and exceeding to WTO, why aren't you living up to them? And the Chinese government always come back and say, but look at automobiles, because it's true. The automobile industry in China is one of the most open ones. It is one of the ones that is most open to international trade, to international investment. Elon Musk, his operations in China are supposedly wholly owned by him. It's on land, it's getting loans from the Chinese government and things like that. But the automobile industry is one of these ones that is wholly up to largely local governments. And what that means historically is when we look at like electric vehicles in China, it means Beijing is counting on the fact that competition amongst all of these local car companies and their foreign partners will in some way produce a better product. However, keep in mind, you remember back about 10 years ago, there was this huge things towards electric scooters or also bikes, in Chinese cities. So you can Google this and you'll just see, bikes. They call it bike share, right? Where you park a bike, and then ride it somewhere, and then you drop it off again, and you get charged for it. And in China, it's all done through your cell phone, right? You don't use cash in China today, and most of the world is moving towards the Chinese system. So it's very easy to just pick up a bike somewhere and then ride it. But you can Google this, you'll find photos of just mountains of bikes, of these bikes being sent for recycling, often places, because there was so much just competition amongst these localities to try to corner that market and to become the leader and to try to get Beijing to say, hey, we're going to back you. And then maybe you can become a global leader in that. The same thing is happening now today. So, places where there's a lot of Chinese, electric vehicles overseas, you're seeing a lot of competition between those. Mexico's a big one, for example, a lot of those different car companies, and they're widely varying quality. So there is a lot of advantage to this. The downside is that there's huge overproduction. There's a huge amount of competition, and if the story about these rideshare bikes, being is telling here, you could have a lot of waste going on and a lot of competition going on that may not be very useful in the long run. So I would say that's like the one thing to keep our eye on, is that when Beijing says that it doesn't really have a dog in the fight, in that particular fight, it really doesn't. And that's the one I think that's probably most directly affecting Chinese oil demand, right? Mm-hmm. Yeah, because Chinese young people in particular are buying Chinese electric vehicles. They're mainly interested in those. And they're developing a huge network, for recharging. But what that also means is you've got, multiple different types of recharging ways. Do we switch out a battery, or do we have a different socket? China is more likely and is already moving towards a lot more centralization of standards and ways of recharging and things like that. It'll get there before we do, probably. That's for sure. But there is that level of competition in that industry in particular that you don't get in other industries.
And does that domestic competition create an exportable product? I mean, Chinese exports of electric cars have been soaring, of course.
Yeah. Especially, I would say, especially in tourist locations like Mexico, for example, and where there isn't also like a competitor. So Europe, obviously, or Japan, that might be an issue, but definitely in places in Africa or Latin America.
Mm-hmm. So it's striking that, on the one hand, these internal dynamics are driving rapid uptake of electric cars, but at the same time, the growing focus on national security has prompted increases in domestic production of oil and natural gas as well.
Yep.
So Robert, and we're beginning to get some questions online as well, and keep those coming. Thank you. My question was kind of similar to one that's already come in online, which is, so financial, discipline, maturing asset. Mm-hmm. How did the United States grow production, if you count gas liquids, by 1.5 million barrels a day this year? Falling rig count, lower oil prices, and yet, how did it grow up by that much this year? And why should we not expect it to happen again next year? Why should we not expect to be surprised again?
Sure. I don't know that anyone has a perfect answer. I think on the margin, the market's been surprised by the amount of growth we've gotten out of the shales. What I would note is we were coming off of a very high rig count at the beginning of the year, right? So, falling rig count, but we started at a very high number. 2022, a lot of the decisions to pick up rigs were a function of the extraordinarily high prices last year. A lot of people produced into that market, and so certainly that's a part of it. But even still, that was well understood and probably priced in, and we've outperformed those expectations. It has been a surprise. I think a story that I hear regularly relates to the drawdown of our drilled but uncompleted well base. So we keep a certain amount of wells in the productive base, which are drilled but not yet completed. It's a very opaque metric. No one has a great feel for exactly how many, we call those DUCs, drilled but uncompleted, how many DUCs there are at any given time. There's certainly a thesis out there that we drew down a lot of DUCs this year, and that is a function of the bump we saw in productivity in September.
Yep, you anticipated my follow-on question. I'd written a few pieces about the DUCs question.
Sure.
I thought it would run out sooner than it apparently did, because that continued to get drawn down, that inventory this year.
Correct. No one has a great feel for where exactly it stands, but I do suspect that was a part of the outperformance of the shales was a DUC drawdown. There's a lot of people with a lot of different stats on where the DUC sit. Certainly, we've drawn them down in the oil market and probably built some in the gas market.
Mm-hmm. So I have one more question I'm going to pose as one question that I would like each of the panelists to weigh in, and then we'll move to some questions from the group. So my question, being a data nerd who ran BP's statistical review of world energy for a dozen years, is about data quality, and my sense is that it's eroding in some ways, and that makes the job harder for us as analysts to actually understand what's going on out there. And I know that there's, Halima, I know this is featured into discussions with OPEC and the IEA and the U.S. Energy Department. I know that China has taken some of its previously publicly available information offline. I know there's running debates about the quality of data coming out of the U.S. shale patch, and so I'd be interested in each of the panelists' perspectives on that. How big of a problem is it? What, if anything, can we do about it? So, Halima, why don't we start with you?
Where I see it as challenging in two areas that I work on is the data on Iran exports and what really counts as an Iran export, what is potentially are these, surging Malaysian exports that we see really disguised Iranian exports? What is happening with dark fleets? So getting a sense of really the robust number on what is Iran putting on the market, I think is challenging. I also find the situation with Russia has been challenging in terms of they've been very good at maintaining their production levels, their export levels, but there are all these issues around, their own gray fleet of tankers. That makes it similar to the Iran issue, like getting your hands on what the numbers actually are when you have these ship-to-ship transfers, when you have these shadow fleets. It's hard to actually sometimes come up with the numbers on those countries. So those are the two areas that I have been sort of struggling with over the past year.
Right. Yeah. Famously, Malaysia is exporting more oil to China than it produces.
Yes.
Oddly enough.
Yes.
So, Steve, from the Chinese perspective.
On data, yes, part of it is that the Chinese government has basically ratcheted up the national security side of this, and part of it kind of started maybe in a way in a reaction to protests in Hong Kong and other places, and I think it's also just a natural feature of one man at the top, Xi Jinping, who controls indirectly a very large planned economy, and also directly parts of a very key parts of a planned economy, but it's also a very large market economy. So there's stock markets in China, right? And a lot of China's middle class, which is quite large and quite substantial, their retirement savings are tied to that, and real estate, and there's a real estate market issue right now in China. So a lot of people are feeling that their retirement savings, are at peril. But there's also a lot of, very entrepreneurial-minded people who say, well, everything comes down to the man at the top. What if there was a rumor out there that his health was not good? Maybe we could make some money off of this. And so some people have been trying that. So the most recent national security law, I would say, is primarily intended towards that side, domestic, opportunists, but it's also very, very concerned. They see what's going on in Ukraine and Russia, and they're also seeing what happens that, hey, if we are going to finally deal with Taiwan, in an aggressive way at some point, we'd better be on top of the global media in the same way that the United States was when it came to Ukraine. And be able to come up with our own narrative to kind of counter that. And Xi Jinping is naturally most concerned with that type of national level narrative. So you're right, they have done that. I would say they've been making so many, especially after the meeting between Biden and Xi Jinping, they've been making a lot more noises about opening up and trying to bring foreign investors back in, because this has been, I think, the only year where you've had a decrease in foreign investment in China. So I would imagine that they're going to eventually, somebody is going to come say, hey, we can't keep, driving, foreign investors out by raiding the offices of companies that produce data different from what we're saying. So I would imagine that that's gonna have to be some type of counteraction towards that. But that's going to be, it remains to see how that's going to play out.
Yeah, there's been an absolute cottage industry of oil analysts this year trying to understand, what's happening with Chinese demand. It's not just a function of the reopening of the economy. There's like imbalances between what they've been buying and what they've been selling and what they seem to have been using, and so everybody's doing, pulling out their old Kremlinology, trying to, parse these fragmentary bits of data. And that's just one example. Although, as Halima noted, it was the, everyone's focus for, prospects for oil demand growth this year. So it was kind of a big question. And how about Stephen on the
Sure. As far as data quality goes, we talked about the duck count, which is an example of no one really knows. I think there's a lot of questions that come up around domestic inventory levels for just oil in tanks. But overall, those are exceptions. The data quality of the U.S. onshore shales at the asset level is very good. I think we're well regulated. We have very high quality data. Shout out to our state. I mean, Texas does a wonderful job through the Railroad Commission of making a lot of high quality data available to all of us. We benefit from it immensely. It drives our investment practice. We live in a world where there's now 20,000 good horizontal wells that we can learn a lot from in West Texas, and we do. And without that, it'd be a lot harder to be an investor. So we're on the margin data scientists in a way that we couldn't be a decade ago. Data quality is really good.
Great. Thanks, Robert. Well, that's good news.
Yeah.
Phew, one less thing to worry
Yeah.
about, I'd say. All right, so when I turn to some questions, I see a hand here, so why don't we go here and then here. Can I just ask, as we head in, please, keep your questions short so we can have time for as many as possible.
Yeah, for Robert, I wanted to ask you follow-ups on your conclusions. So you mentioned that public companies are becoming a larger share and they're taking over some of the private companies. Can we, and you said that they were less responsive to prices. So can we, is that an implication that we will see less elastic shale, production will be less elastic to prices? And the other question, given the sort of lack of future inventory that concerns the industry, what do you foresee them trying to do? Is there any place in the U.S. that they can move on, or what about Argentina, or is there anything else that they can apply all this knowledge and technology?
You got it. Elasticity of supply, I agree with your comment. Yes, that is probably on the margin. We are less elastic than we have been in the past. I think that the data would probably support that, and certainly to the extent that they are gobbling up the private companies, which I noted have been the most responsive. On the margin, they'll be less responsive as a shale industry. Your second question is a really good one, which is, what do we do as we run out of inventory in this country? And absolutely, the answer is we're going to start exploring again. That's not been a part of oil and gas for most of my career, but you're going to see people spend more time offshore than they have. Right, offshore has been a bad word for 8 to 10 years. I think that will probably change again on the margin, and certainly places where they can go apply shale technology. Argentina comes to mind. They will definitely do that. There's a number of really high quality shares in Latin America, shales in Latin America, which will catch a bid from large publics. They already are. People are spending a little time down there, and we will expand some of the onshore North American shales. There are a couple of shales in Canada in particular that I think are still in the early innings and will be really interesting to folks over the next decade. The Powder River Basin in the kind of Rockies is another example, but the big ones, the biggest ones have been Appalachia for gas, the Permian Basin, and the Eagle Ford for oil, and those are the ones where we've kind of found the edges more or less. What's left is sort of the small scraps, and so those have been the big driving engines, and that's going to change.
To Halima. So how realistic is IEA's prediction of a demand peak at the end of this decade or so, when we haven't really changed much from about 82% oil or fossil fuel percentage of the energy demand over a long time? And really, if we want to change, or like people or countries are trying to make more based on electricity, and electricity percentage of the total energy demand is fairly small percentage. It's most countries. My country, I come from Norway, have 50%, but that's the exception. And it takes enormous infrastructure developments to do that. And how fast can that be done?
I mean, you come from Norway, and Norway has been the big savior of Europe on the gas side. And so I think that the really interesting question with the IEA projections is how much is policy dependent, and how much in reaching these scenarios is dependent as well on unlocking, incredible sources of capital to reach these goals. And so that was one of the big things that came out of of COP was that all the pledges that were made in terms of tripling renewable capacity, methane abatement pledges, all of the things, the decarbonization alliance. But when you talk about the overall goals, these are a drop in the bucket in terms of the financing that will be really required to meet these really ambitious targets. I'm in Washington now, and just on things like hydrogen, again, like the amount of private capital that's going to have to be unlocked to reach these goals on hydrogen build out are enormous. And so again, I think that this is something that is going to be really dependent on what is the enabling regulatory environment and what is the enabling environment in terms of capital. The last thing, though, I would say is that the developing world, I think, is going to be really worth watching. Places like sub-Saharan Africa that really suffer from energy poverty. One of the biggest issues that I felt came out of this COP, and this was the first COP where you really had the oil and gas industry participating, having a seat at the table, but also a bigger voice for the developing world in these conversations. And not only did you have African countries talking about, again, the need for an equitable transition in terms of energy access, saying that they were not responsible for the emissions challenges that we're facing today. And, the question, though, is who's going to help them financially, accelerate the transition and build out renewable capacity in their countries? And should they be compensated for keeping their own fossil fuel endowment in the ground? And so, again, I think that is going to be the real issue is that can we even deliver on these ambitious IEA projections based on where we are in terms of policy and finances?
Thank you. I have a few questions here online I want to turn to next. For Halima, one of the questions is about when and how might Saudi Arabia begin to unwind its voluntary output, the lollipop that you mentioned?
I think this is if I say that there's a couple really important wild cards for this year, U.S. production is certainly a wild card. But really what Saudi Arabia does with its unilateral cut is an important wild card. The Saudis came out at the virtual OPEC meeting and announced that they would roll over their unilateral production cut through Q1 when we had some market skepticism about the OPEC announcements, particularly because of the fact that they were not announced at one time, but were being announced sort of country by country on the voluntaries. You did have, statements from the Saudis. Prince Abdulaziz gave a pretty wide-ranging interview to Bloomberg News, where he said that he could extend beyond Q1. And so that, to me, I think the Saudis remain resolved at this stage to continue to manage this market. But I think there are some growing whispers amongst market participants about, are we on the precipice of a 2020 situation? Like, how long do the Saudis want to continue to forgo revenue, to forgo market share by giving room for shale producers to grow? Now, I would say that the experience of 2015 was not a good experience for them. I think they believe that they lost control of the market. The fact that they had to do this alliance with Russia in 2016 was a view because they could not manage the market without Russia in the face of U.S. shale. So I don't feel there's appetite to go back to a 2015 situation or a 2020 situation. But the way they manage this voluntary will be important because they've already scaled back some of their Vision 2030 targets. That's their big economic transformation program. And so the question is that because they are sort of adjusting to a oil price outlook in the 80s or potentially low 90s, sort of saying we're not going to get back to 100? Or are they thinking about a potential return of that 1 million where they go for a bit of a volume, even though they don't get the $100 in terms of price? So I know it wasn't an easy answer, but that's certainly a situation that we're watching very closely.
Absolutely, and with the kingdom, already on track to run a budget deficit this year with prices at in the 80s. So I have a couple of questions here with the gentleman with the white shirt, and then the gentleman right in front of him.
For you, in your inventory consolidation scenario, how would you describe bringing our inventories up by using different benches? It's vertical inventories.
Of course. Certainly we have emerging benches in primarily in two basins. One is in West Texas and the Permian where we invest, and there's a series of benches in the Powder River Basin, which I noted. Those are the two big stack pays. We are seeing on the margin emerging benches, but the Wolfcamp A is the biggest provider of resource in this country, and it's the one that everyone's focused the most on. We're not finding new Wolfcamp A resource. Specifically, the emerging benches that we see are Barnett Shale, as it exists in West Texas, right under the Central Basin Platform, is a really interesting emerging play. There's also a play called the Harkey Sand in New Mexico in Lee and Eddy counties, which is really a limestone between the second and third Bone Spring. So there are those. I mean, they exist, but they're sort of all on the margin from a big picture standpoint. I don't see another Wolfcamp A appearing.
And is that where we go exploring next?
Maybe. I think we'll do some exploring between the benches we've already drilled, but we log every well we drill, right? So we have a pretty fulsome log. We know if we just skipped over a bunch of hydrocarbon, we would have known it. It would surprise me very much to find a big productive resource in between a bunch of wells we already drilled out there.
We have a problem with leases expiring. We're getting in 2, 3, 5 year period when these leases were originally taken. Are we going to see all of a sudden this coming year rash of drilling in order to maintain leases that might be expiring?
Not in the oil plays. I wouldn't expect it. The only place where I might expect that to become a problem could be in the Haynesville Shale, because that was a really re-emerging resource a few years ago, which has had to be quieted down in a meaningful way as gas markets have retreated. And notably, Louisiana has different laws as it relates to how leases expire, right? It's much more efficient. Actually, it's better for their economy the way that they've got it set up. In West Texas, as an example, where we spend most of our time, you can hold a giant lease with one 1970s vertical well. And so, no, most of the acreage is held by the current production. We do not expect there to be a big issue with lease expiry. Thank you.
Mm-hmm. Okay.
How constrained are you by interstate versus intrastates? You mentioned, Powder River Basin.
Yeah.
You're going to have a long haul pipe out of there. These folks don't seem to be very supportive of the current administration of that sort of thing. Hence the focus in Oklahoma, Texas, Louisiana, where I can get my takeaway capacity and get it to market.
Pipes that cross state lines are a serious subject and scare all of us immensely. It's a super important part of the gas market. Obviously, oil you can put on a truck. But I think that we think a lot about the LNG export business that's being built out in Louisiana and whether or not the Haynesville, as it exists on the Louisiana side of the Louisiana-Texas border, can support it. I think there's a belief by at least part of the market, well, if the Haynesville can't support all of this liquefied natural gas growth, that's okay. The Permian and all the gas that comes out along with the oil will be there. I think that is that what that requires is a bunch of pipes that have to get built across that little state line. That's not going to be so easy. So we'll find out how that story plays out late this decade. But it's a real subject. It's an important subject. The federal government and FERC's lack of willingness to support interstate pipeline growth is a serious problem.
And as it is at the state and local level as well. It's,
no question.
So I'm going to take, we'll have one more from online, and I'll take one more final question on the back here. So the question that comes in from online is also for Halima, is prospects for OPEC additions or subtractions. I mean, you mentioned Brazil joining the OPEC Plus group, and you also mentioned the standoffs that are being had with Angola and Nigeria. So what are the prospects for the group to add or subtract, and does it matter?
I think Brazil is one that would matter. I mean, they announced that Brazil would be joining OPEC Plus, not OPEC, but OPEC Plus at the last meeting. And to me, that was a meaningful addition if Brazil would submit to collective market management. Brazil was a big source of supply this year, 500,000 barrel growth this year, but it's expected to grow significantly over the coming years. And so if Brazil would submit to collective management, I think that would be a big win for OPEC. But Brazilian officials, Petrobras, even Lula, were quick to come out and say that they were going to be OPEC plus observers and that they would not be restricting output at this stage. And so there really is a question mark over what Brazil's membership actually means. Some have said that Brazil likes to join clubs. The question is, what is actually, are they going to pay their dues in this case of OPEC plus? Angola, in terms of, who could potentially bolt from the producer group. Now, I think Angola has been a sort of a more emotional member of OPEC, for the past couple of years. I mean, I've been at many OPEC meetings where at midnight, the Angolans walk out because they're not happy with the tenor of discussions. So Angola being unhappy is not a new phenomenon for this country. They are a relatively late joiner into OPEC. And so the question is, what is really Angola getting out of membership? But if Angola leaves, I think it's similar to sort of Indonesia leaving. I don't think it is material for the functioning of OPEC. I think it would be much more significant if we were to lose a country like UAE. I actually think that solving the UAE production numbers in June was actually a very big accomplishment of Prince Abdulaziz. And so the fact that UAE is really still in the OPEC camp, I think that is very, very important for group cohesion going forward.
Mm-hmm. Thank you. And we've got time for one more question in the back, please.
I was wanting to ask about, get your thoughts on the EIA monthly drilling productivity report, which is showing kind of shale oil growth declining since June, July, depending on, when you look at the numbers. And you typically also have a seasonal kind of decline in rig count when you get to year end. Shouldn't we expect to see U.S. oil production decline essentially in the first half of 2024? Your thoughts on that?
I think there's a good argument for it. I think that's entirely possible. People have been concerned about the outperformance of U.S. shale, but as we experience it, we sit here at $69 WTI today. With all of the oilfield service cost inflation that we incurred in 2022, and it was very substantial, there's a lot of inventory that just isn't particularly economic today at this oil price. So one of two things have to happen if you want to see a meaningful response in a lot of the shales, which is either oilfield service pricing needs to come down or oil prices have to go up. So if neither of those things happen, I think it's entirely practical that we see a decline out of the shales.
Well, you heard it here first. The prospect for U.S. production to decline.
Entirely possible.
So, well, I wanted to wrap us up here. I want not to take advantage of your time. There are more questions that unfortunately we've been able to get to today, and I apologize for that, but appreciate your patience. So let me just briefly wrap up. We're heading into 2024 after an eventful year. If you came here today hoping for a price forecast, we didn't give you one. The panelists may feel free to jump in if they want it. Although personally, in my years in the industry, it wasn't really about predicting the prices as much as it was understanding the directional pressures and the key drivers of that. And we've talked a lot about that in terms of OPEC and China and the U.S. As the kind of the moons that will impact where the tide takes us for oil markets in 2024 and beyond. I mean, one thing we can bank on is that we're going to get surprised. Another thing we can bank on is that it's going to be important. And we'll be here to cover it with you all. I mentioned at the beginning that the oil market, and energy, is a small world. The reason why is because we have sessions like this. This is how it becomes a small world, after all. Sorry, I couldn't resist the temptation to go Disney on you. But it is, after all, a small world, and you play a big part in that. We value the relationship. I hope that you'll join us at future Baker Institute discussions. Hope that you and your loved ones enjoy the holidays and a peaceful 2024. And with that, let me wrap up for the year here, and please join me in welcoming and thanking our panelists for a great discussion.